Hello traders, you're welcome to this video and you're welcome back to the Forex Geek channel. Okay, if you are looking to boost your Forex strategy, you've clicked on the right video. In this particular video, we are going to be diving deep into a powerful combo, and that is the ADX and Stochastic oscillators. By the end of this video, you have a solid understanding of how to use these two indicators together for better market analysis and smarter trade decisions. But before we jump in, make sure to hit that like button and subscribe to the channel so you never miss out on our latest Forex tips and strategies. So first of all, let us start by talking about the ADX, which stands for average directional index. So I'm just going to be loading the ADX to the chart, average directional index. I'm just going to be loading it to the chart first of all. Okay, as we can see, this is the ADX that we have on the chart. Now the ADX is a trend strength indicator and is crucial for understanding whether a market is trending or not. Many traders get stuck trying to trade in a sideways market, but with ADX, you can avoid this by identifying strong trends before they happen. The ADX is displayed as a single line. This is the ADX line itself, typically ranging from, let's just have this as fixed maximum and fixed minimum. All right, so you can find the ADX ranging between 0 and 100. Okay, if the ADX is below 20 or 25, it indicates a weak trend or a flat market. If the ADX is between 25 and 30, the trend is getting stronger, and when you have the ADX above the 30 level, it shows a strong trend, one worth paying attention to. So as you're analyzing the market, you might want to look for an ADX above 30 to identify if a trend is in play, and watch for higher readings to signal increasing strength. All right, now how do we actually use the ADX in our strategy? When the ADX starts rising above 25, it's an early signal that a trend is forming. All right, so as we can see here, let us use this example. We can see when the ADX was rising, as it got above the 25 mark, you can see that around that point, that was when we had this upward trend beginning to form. Right, as you can see here, we had an upward trend right after the ADX began to climb above these levels. Okay, and then when we had the ADX began to see a significant drop right after here, when it dropped here, we had a pullback, right? And you can see when it dropped here again, we had another pullback. And then when it now dropped significantly below the 25, we eventually had a reversal. All right, as we can see here, we eventually had a reversal. Okay, now here is the trick. When you have the signal from the ADX, you don't just jump in immediately. Okay, wait for the trend to develop and for the ADX to confirm its strength. For example, if you are watching the XAU USD chart, this particular chart, and you notice that the ADX is around 25, okay, it's telling you that a trend may be in motion. But if you wait for the ADX to rise to 30, you will have more confidence that the trend is not only strong but likely to continue. If the ADX starts to dip back down below 25, it's your cue to exit your buy trade or your sell trade if it was a sell trend that you are riding, and it's going to be your signal to exit your trade and hold off for or hold off on new entries. So this helps you avoid trading in choppy uncertain market conditions. Now, next up, let's talk about the stochastic oscillator. So I'm just going to be adding the stochastic oscillator to the charts right away. Now, the stochastic oscillator is a momentum indicator and it's super useful for spotting overbought and oversold conditions in the market. It is not concerned with trend direction like the ADX, but rather it helps us pinpoint entry and exit points. The stochastic oscillates between 0 and 100, with levels typically set at 20 and 80 to identify overbought and oversold conditions. A reading above 80 indicates the market is overbought, which could suggest a potential reversal to the downside. A reading below 20 indicates an oversold market, suggesting a potential reversal to the upside. These signals are important because they help us understand when a trend might be overextended and due for a correction. Now, here's where the magic happens, combining both indicators for a winning strategy. The key to this strategy is understanding how to use the ADX to confirm the strength of the trend while using the stochastic to find the perfect timing for entries and exit. Now, let me walk you through a simple example. Let's say you are trading the XAU-USD pair. First, you have to check the ADX, all right? You want the ADX to be above 25, all right? Now, ideally, you should even wait for the ADX to be above 30, okay, to confirm that a trend is in play. Now, the next thing you do is to look at the stochastic oscillator, all right? If the stochastic is below 20, it signals that the market is oversold, all right? Signals that the market is oversold, which could mean it's about to bounce upward. This is your potential buy signal. Now, if the stochastic crosses above the 20 level, right, like we had here, we can see that around this point, we had the ADX cross above the 30, and here we had the stochastic from the oversold crossing above the 20, all right? Now, if the stochastic crosses above the 20 level, from the oversold zone, and the ADX is still showing strength like we had here, you've gotten the green light to enter the market. On the flip side, if the ADX is showing strength but the stochastic is above 80, it's time to be cautious as the market might be overbought, all right, and a reversal could be coming. By combining both indicators, you get a more reliable entry point and you'll avoid chasing trends that are about to reverse. Now that you understand the basic strategy, let's cover some practical tips to make sure you are using ADX and stochastic effectively. First, remember that no strategy is perfect, so always use proper risk management. Even when you have both indicators lining up perfectly, market conditions can change and things don't always go as planned, all right? So always set your stop loss orders and manage your position size appropriately, okay? For example, if you are in a buy trade, an ideal place to set your stop loss would be just below the previous swing low. And as for the take profit, you can use the nearest resistance zone for your take profit. If you are in a sell trade, an ideal place to set your stop loss can be just above the swing high, the previous swing high, and you can use the nearest support zone for your take profit, all right? Or you can also use the stochastic, to determine your exit points as well, okay? Now, it's also essential to backtest this strategy before applying it to your live trades. Go through historical data, apply the ADX and stochastic, and see how it performs in different market conditions. This will give you more confidence when using the strategy in real time. Thirdly, use these indicators on different time frames to get a fuller picture. The ADX and stochastic are effective on all time frames, but a longer time frame can give you a better idea of the overall trend, while a shorter time frame can help you time your entry more accurately, all right? So to wrap it up, using the ADX and stochastic together is a powerful strategy that can help you identify strong trends and make more precise entries and exits. Use the ADX to gauge trend strength. If it's above 25, you've got a trend worth watching. Use the stochastic to pinpoint overbought and oversold conditions, giving you the perfect opportunity to enter or exit a trade. Combine both for even stronger confirmation and better timing. This strategy is a great addition to your trading toolkit, and with patience, it can significantly improve your trading decisions. If you enjoyed this video and found it helpful, don't forget to give it a thumbs up and subscribe to the channel for more tips, strategies, and insights on Forex trading. Thanks for watching, and I'll see you in the next video.